Can a C-Corp retain earnings for future growth? In today's business climate, many are asking an important question. Can a C-Corporation retain earnings for future growth? This topic has gained attention recently, especially as companies look for ways to fund their expansion without incurring additional taxes. A C-Corporation has the ability to keep its profits within the company instead of distributing them as dividends. These retained profits are known as retained earnings. The key point here is that retained earnings are taxed only once, at the corporate level. Currently, the federal income tax rate for corporations stands at 21% as of 2025. This means that the money left after paying this tax can be reinvested in the business for future needs. When a C-Corporation chooses to distribute profits as dividends, it faces double taxation. First, the corporation pays taxes on its earnings. Then, shareholders pay taxes again on the dividends they receive. By retaining earnings, the corporation can defer the second tax on dividends. This strategy allows companies to fund growth without triggering immediate tax liabilities for shareholders. There are several reasons why a C-Corporation might opt to retain earnings. For instance, the company may wish to reinvest in new projects, purchase equipment, or build cash reserves. Retaining earnings can also help avoid taking on debt or issuing new shares. However, shareholders often expect dividends, and excessive retention without clear business reasons can lead to disputes or even legal challenges. From a legal standpoint, business law does not prevent C-Corporations from retaining earnings. The decision typically lies with the board of directors, who must act in the corporation's best interest. While state laws and corporate bylaws may impose some limits, these are generally flexible. The primary tax consideration is that retained earnings are taxed at the corporate rate, while distributed earnings face a second layer of tax at the shareholder level. In practice, many growing C-Corporations use retained earnings as a key part of their financial strategy. This approach allows them to fund expansion while managing tax liabilities. It is a common practice in business law, provided the company adheres to proper governance and tax regulations. To summarize, C-Corporations can legally retain earnings for future growth. These earnings are taxed once at the corporate level, and the decision to retain or distribute profits is a business choice influenced by governance and tax factors.